Are you wondering how the pandemic will affect the stock market returns in the near future? Well, the recent Vanguard report, Beyond the Pandemic, What to Expect from Stocks and Bonds, gives us a good overview of the expected return of several asset classes. Let's take a look at those, and I'll also show you how you can backtest those asset classes in Portfolio Visualizer so you get an idea of historical performance. So let's dive right into it. Welcome to another episode of Investing with Kurt, the channel where we focus on real investing advice rather than trading and speculation. So for today, I want to take a look at Vanguard's Futurecast for the next 10 years. As I always say, no one can predict the future, especially when it comes to investing. But Vanguard is one of the sources that I truly trust because they have a very good track record and they always look at long-term horizons, say of 10 years or so. In this report, they do describe their approach and their proprietary Vanguard Capital Markets model for scoring, which they call VCMM, and I want to highlight why this is a better than your average prediction coming out of investing gurus and such. Vanguard says they don't offer guesses about where the market might be in 1 or 3 months' time. Rather, their VCMM forecasts are for annualized returns over a 10-year horizon, which reflects Vanguard's long-standing view that investors should have long-term outlooks. They have a good track record with reasonable degree of accuracy over this time frame. Alright, so I'm going to skip to the more interesting part here, which is the prediction of stock returns for various asset classes. Vanguard says their annualized nominal return projections over the next 10 years for US equities are in the range of 5.5 to 7.5% returns. At the same time, things look different for international stocks. Returns for non-US equities over the next 10 years are likely to be higher, around 8.5 to 10.5%, a differential versus US stocks that underscores the benefit of international diversification. If you look at the visual representation here, Vanguard lists all the asset classes in a descending order in terms of volatility, and for each, they give us their forecast of annualized expected returns. At the very bottom, as least volatile, we see US equities and US large cap. These are basically your total US stock market and the S&P 500, which is a large cap blend. Moving up the volatility projections, you will see that higher volatility does not necessarily give you higher returns for the next 10 years. But to me, interesting asset classes to compare are large cap and small cap. As we see, small cap's volatility is the highest, however, its expected return is also higher in this case. Now, to make this a bit more tangible for you, I would like to show you the Portfolio Visualizer tool, which we can use to backtest those asset classes and how they performed in the past. Again, past does not necessarily give us what's going to happen in the future, but it is the best we have to look at. So in Portfolio Visualizer, we have data dating from 1972 to current date for all the major US asset classes. Let's take a look and compare the return of US equities versus US large cap, the ones that Vanguard predicts to be returning about 5.5 to 7.5% with the lowest volatility. And in the visualizer, I'm going to use the default settings, data ranging from 1972 to 2020, and we're going to use $10,000 as your initial amount. We have the ability to compare up to 3 portfolios at a time, and in practice, you will have several assets in a different percentages per portfolio. That's your asset allocation, but I'm simply going to compare just 2 portfolios comprised of 1 asset class each, so we can see the difference. Let's look at how we would have done if we invested $10,000 in US equities versus US large cap for about 50 years. So when I click on Analyze Portfolios, we will see what was the return of each portfolio. Portfolio 1, our US total stock market, returned a little over $1,110,000, while Portfolio 2, the US large cap, only resulted in about $18,000 less. So the difference is really minimal, with a very slight outperformance of the total US equities, total stock market. And if we look at the other statistics, the standard deviation, best year return, the worst year out of the bunch, market correlation, the differences are very, very small. That's why you see in Vanguard's predictions that those would do about the same in the future. Now, if we compare the US total stock market to, say, the more volatile asset class such as what Vanguard predicts to be the US small cap, we get a totally different return. Let me change this to US small cap and hit analyze here. What we get then is that small cap, again for about 50-year time frame, which is a very, very long time horizon, return over $1,700,000. That's quite a bit more than the total US equities. So in this case, the higher volatility of the small caps and holding them for a very, very long time paid off and gave us better returns. However, it's not advisable to have a portfolio of a single asset class such as the small cap only. But let's go back to Vanguard's forecast that states international equities as a whole would do better than US equities in the next 10 years. Let's try to backtest those two asset classes and provide a bit more insights of what has happened in the past. I'm going to use the same default settings for Portfolio Visualizer, but under International Equities, I'm going to select Global ex-US Stock Market. This basically means Global Total Stock Market excluding the US stock market. So when I hit Analyze, let's see what we get. We get a huge difference in return for the two portfolios, but let me clarify a couple of things first. Even though we selected a start date of 1972, the data for international stocks is not available so far back. So we only get data, as we see from the chart, starting from about 1982 until current date. So we can look at not a 50-year time horizon, but only about 34 years of history. And what we observe here is that US equities return $278,000, while international, which is our portfolio 2 here, only return about $86,000. So you may say, why should we invest in international then? Well, according to Vanguard, US stocks have been overvalued for quite a long time, while internationals have been undervalued for a while. So they project that tables will turn and now international will have the higher return. In my opinion, it is good to have some international in a stock portfolio to further diversify and not bet on a single market. Again, past performance does not necessarily give us the future outcomes, but if you look at the line chart below, between 1986 to about 1992, international did outperform US stocks. Alright, let's go back to the Vanguard report and examine their prediction on fixed income, or that's your bonds and cash holdings. Vanguard says they stand at a range of 0.9 to 1.9% return for US bonds and a little less for international bonds, namely 0.7 to 1.7% return. So if you look at the picture they provide, again sorted by most volatile in descending order, we notice that cash deposits are expected to give us about 0.6 to 1.6%, and obviously they are the least volatile. When it comes to bonds though, most people would be investing in US aggregate bonds, or that's your total US bond market index, and that would give us moderate returns. One of the outliers here is US high-yield corporate bonds. They're right up to what equities would return, but they have a significantly higher risk for this asset class. The reality is people would be looking into fixed income and stability, so they would have some mixture of TIPS, US total bond market index, some cash holdings, etc. And overall, we can't expect very much from bonds returns. And that is okay, because bonds' purpose in a portfolio is to stabilize our overall portfolio volatility and help us stomach the bad times. Or if you're closer to retirement, you may not want to bear the risk of equities. Let me jump back to Portfolio Visualizer one more time here and show you how bonds compare to stocks in a long-term portfolio. And just for the sake of illustrating the difference, I'm going to compare total US equities market to the total bond market. We hit Analyze here, and what do we get? By the way, bonds also don't have the data all the way back to 1972, so we will settle for data starting from 1987. So what do we get? Obviously a big difference. Bonds only resulting in $69,000, but look at the line chart here. Bonds have a very smooth, gradual rise, no volatility whatsoever. Standard deviation is very low. In the worst year, bonds only went down by 2.66%, but again, they're a safe bet and you can't count on huge returns for bonds. In practice, people would have a conservative asset allocation between stocks and bonds, and they would go for something like this 60-40 portfolio. Let's look at that as well and see the difference. So if I change my portfolio to here to be 60% US stocks and 40% total US bond market, what do we get? We get a lower return than the pure equities portfolio, so about $80,000 less, but also we get a smoother ride. So if you're risk averse, you may do that. In your worst year, you could be only losing about 20%, or your max drawdown may be only about 30% compared to 50% for the all equity portfolio. But in reality, it comes down to personal preference and the risk tolerance that you have. Alright, and I'm going to wrap it up here with a last quote from Vanguard's report. They say, "We hope that investors who already have a sensible investment plan designed to carry them through good markets and bad will have the discipline and perspective to remain committed to it." And this is why you hear me say on this channel that it is important to have an investment plan, solid asset allocation, and execute based on those through thick and thin. You have to be committed and you have to stay the course. Thank you guys for watching. I hope you learned something new today on investing. If you enjoyed the video, make sure to destroy the like button as usual, and if I missed anything, drop it down in the comment section below. And if you're new here, please subscribe for more videos on real investing advice. Check out some of my other videos from my investing playlist also. So until next time, stay the course and keep investing on a regular basis.